Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for that common sense approach to planning for a more stable, secure financial future. What we need to do with our money, our investment, our retirement accounts in order to face the risks and the variables that we will encounter through retirement. And Chris, we always appreciate your time here on the program. He is Chris McIntire of McIntire Retirement Services. Welcome back in, Chris.
Hey, Peter, good to be with you. Good to be with everybody. Hope everybody's doing well.
And Chris, I am. Thank you very much. Glad to see you back once again here, bringing the information, discussing the risks that we face. These are important topics that we talk about each and every week here on the program. I do think Northwestern Ohio savers and investors are paying attention. You're hearing from a lot of people that have reasonable concerns about retirement right now. I mean, we are facing a lot of headwinds, even though so far 2023 has been a pretty good year in the markets.
It has, Peter. It's been led by the tech sector by and large, and I think some of the talk about artificial intelligence has fueled the growth of that tech sector that obviously took the biggest hit in 2022. And the discussion of further rate increases is some of the headwinds there. I mean, everybody's been waiting for this recession that has yet to hit. And, inflation is persistently hanging in there in that 4 to 4.5% range, what they advertise, out of the Fed there. So there are, there's a number of issues. I live up here by Lake Erie, and, we've been dealing with, smoke and mayflies that we get up here. So, my goodness. And you walk into the office and you got to clean the door off here. They just, it's a sign of a healthy lake, but man, do they make a mess.
Indeed. Yeah, Chris. And we deal with some pests in the financial world as well. Inflation has been pesky, kind of hanging around. And I know they said it was transitory at one point in time. The rate of inflation growth has certainly slowed, but the fact that prices are higher today probably is not going to go away and not going to reverse course. I don't think that really ever happens. Should we expect to see a reversal of inflation?
I think it's going to take some time. It is something that they certainly got wrong when they called it transitory, because it is not. It is well entrenched here. And, the cause of it was obviously government overspending coming out of the COVID pandemic. And, we can move on from that at this point because we're dealing with it in the present now. That's why they're talking. They did a pause in June on interest rates just to kind of see, okay, after was it 10 in a row, I believe it was, and they took a pause here. And it sounds like we're going to get at least 2 more rate increases in July and August, from what I've read and listening to all the articles and the news programs that we pay attention to. Now, is that going to have the biggest impact on the bond prices like it did last year? Probably not, because there'll probably be quarter point increases. So the shock is not necessarily anything new. It's pretty well entrenched. I think people are expecting it. But, as inflation took a hold with the goods we buy, obviously then it fell into the labor market where people were asking for more money, wages, to keep up with the cost of living. It's hard to get that out of the, wage-driven inflation. It's hard to get out, right? People have to lose their jobs for incomes to go down. And, that's typically not a good thing for people to have happen to themselves.
Although we are hearing that more and more Americans are living on credit cards, or that they are at least carrying more balances over. And with these higher interest rates, Chris, that's more painful for people.
Yeah, without question, not everybody, lives above the poverty line. There are many people right at it or even below it that are, good, hardworking Americans that struggle to get through from paycheck to paycheck. And, rising interest rates, rising food prices, really hits that, those, for lack of a better word, the bottom rungs of the economic ladder, if you will. And I don't think that's a surprise to anybody, but, that's where, you want to do the least amount of harm, obviously. People that make, a fair, decent living can obviously handle a little bit of, price adjustments a heck of a lot easier than somebody toward the bottom. But, in society, it's just not that easy to inflict pain here and not have it impact down here.
Once again, we are talking with Chris McIntire, president and founder of McIntire Retirement Services, your resource, ladies and gentlemen, for information on a more confident financial and retirement future, home of the game plan for retirement, the written document that outlines your financial future that you can base your financial strategies on, trying to optimize income, investments, taxes, healthcare, legacy, formulate that plan and have it in writing, helping to optimize your financial future. Pick up the phone if you would like to get that conversation started or get that plan in place. 800-868-1194, 800-868-1194, 800-868-1194. Now, Chris, in this audience, I think that we've generally probably done better in managing our finances and investments, but still reasonable concern about the prospects and the outlook for retirement. Many conscientious savers and investors tune into the program. We hear from them, but there is still concern with running out of money in retirement or with making sure that we maintain that level of confidence that the paycheck once provided once we do retire and walk away from it.
Yeah, and running out of money, with a 401k or an IRA that has a zero balance is a lot different than running out of income. And we like to structure income where we have contractual guarantees to, know that we satisfied, the daily living expenses, if you will, and we've got that taken care of. And then we have an investment portfolio on the other side that, we can get some, try to keep up with our pace of inflation there and, try to find that right balance there on every particular client. Because obviously everybody listening to the show here, some people might fit in, stereotype A, stereotype B, and stereotype C. And stereotype C may have, husband, wife, both with pensions, both with Social Securities, and they don't even need their assets for income. Where stereotype A is, hey, we're in that, we don't have much margin of error. That's probably a good way to describe it. So we got to be careful on the investing side, and we really need to make sure that we've structured an income stream that's going to satisfy their needs over their lifetimes.
It really is unique and individual and situational specific. But Chris, I think most people don't want to make mistakes or missteps. And that's where I think that the benefit of working with an advisor really shows its value in that we retire once. We want to do it correctly, but we can't afford to make some of the same mistakes that others have made, right? The saying is smart people learn from their own mistakes. We really don't have that time or luxury in retirement. You as the advisor, you have seen countless thousands of different people's situations, all with different intricacies, but have been able to identify many of the strategies that have worked and seen some of the things, unfortunately, that have not worked for others.
Yeah, and all day, every day, I've got family members that some have done well, some have not done not so well. So, you live about it in your everyday life and then in our professional life, and you can see who has done a very good job at their planning. And you can also see those that have not done such a good job on their planning, not necessarily through any fault of their own, just because life is what happens to plans sometimes. And, a lot of, very often it could be a health related issue that really upsets the apple cart, Peter. Somebody, had to retire early because they had a stroke or cognitive issues. There's so many different facets to this, and as, I hit I'm going to say my mid 50s. Obviously, we pay a lot of attention to healthcare and whatnot, and, things don't heal as fast as they used to. I can't rollerblade or ice skate nearly as good as I could when I was in my 20s.
Although I've seen you on ice, Chris, fairly impressive.
Yeah, not bad. That's one thing I could do. And my wife was funny that for my 58th birthday, she bought me new skates and new rollerblades. So how about
Nice.
that?
Nice.
Yeah.
Well, Chris, I did have a listener to the program actually make a comment related to that, saying that, something that you guys should talk about is the fact that your health is your wealth, and that keeping good routines, good habits from a health standpoint really equates to a higher level of confidence with your wealth. And to that individual, I made the comment that, yeah, absolutely, you can have good health and good routines and habits your whole life. And then you get to a certain age and you say, man, I'm sure lucky that I made it here healthy. And you'd be right, but you also did some of the things that increase the chances and the odds of that luck occurring. Chris, I know you're very health conscientious. Talk to that comment. Do you think that I responded correctly there?
Yes, Peter, and I'm passionate about this, so I appreciate you bringing it up to me. And just recently, my mom turned 86 years old. My dad turned age 90, and he played, wanted to play golf on his 90th birthday, but the smoke was so thick from the wildfires that he couldn't. But they keep active. His mom was 98 when she passed away. Wow. And had always done a good exercise routine, and and I work out of 3 offices. We have one in Perrysburg where you go up a couple of steps. I'm here today recording in the Port Clinton office where we don't have any steps. And then in the Fremont office, we have probably 14 steps. We're up on the 2nd floor there. Just, it was the space that was available, a decade and a half ago when we rented the office. And so I have a lot of clients that say that can't come up the steps, or, it's getting more difficult. And for some of them, it's because their joints are failing. And, but I also want to put it out there that, you need to keep your strength up and going. You have to keep your health up. You need to maintain that balance so you don't become a fall risk. And, so many people don't have an exercise program, because you can have all the wealth in the world. If you don't have any health, you're not going to enjoy it. So I try to tell folks, look, enjoy your wealth and your health, and focus more on your health as well.
Well, Chris, excellent point there that I want to bring up. You do offer in-person meetings at your 3 office locations, conveniently located for savers and investors across Northwestern Ohio, but also the ease and convenience of virtual meetings is available. If easier or necessary, you do meet with people virtually, or even phone calls can get the job done at certain points in time in helping people to better identify the strategies with their money to be more efficient and effective, and to provide for helping them achieve their financial goals. So very easy and convenient to get the conversation and the process started, to get the plan in place, ladies and gentlemen. One of 3 different office locations, or with a phone call or virtual meeting. Give Chris McIntire a call to get that process started. 800-868-1194. That's 800-868-1194. 800-868-1194. And Chris, I know that's not on our list of hot topics, but I actually think that that is a very important topic to address. That gentleman that brought that up, I appreciated the comment and the feedback, and I'm sure he appreciates us discussing it on air. So I know another factor that you talk a lot about, Chris. Yes, the market has been pretty advantageous here in 2023 thus far, but basing the decades of our financial future stability on a provenly unstable market is something that you talk about, and during good times in the market is the best time to address whether or not we should continue doing so.
Yeah, exactly. As we try to, work on things that are more predictable and to take out reduced volatility, portfolio construction just becomes paramount in what we do. And, as we're talking about this, Peter, and you and I talk off the air all the time, is how we're doing that in a rising interest rate environment, in trying to, create more yield, more income. reduce portfolio volatility, because it's that 25% loss in the market that becomes hard to overcome. I got a number of clients that'll probably watch this video that retired, right at the beginning of 2022, and then all of a sudden the market dropped, and how do we recover some of those gains while taking income out of the accounts? And there's one in particular, he'll know who I'm referring to, is we use a bucket approach. We've got a higher risk bucket, a moderate risk bucket, and then like a low risk bucket. And and that higher risk bucket is to get longer term growth to outpace inflation over the course of their retirement. Somebody listening to the show might be 60 years old, and that makes perfect sense. We may have somebody today who's 75 years old, and they may not want anything in that high risk bucket. They're really trying to, just be nice and conservative, and, and go through the rest of their golden years here, with more predictability, if that makes sense.
It is, Chris. I've heard it put a couple different ways, different buckets of money, different colors of money. But essentially what you're talking about is balancing the portfolio and addressing it in a time optimized fashion, where near future money has very little to no risk, and future money that maybe not next 1 to 3 years, but that we know will need and rely on into the near future may have another degree of risk, whereas long-term money may have a separate degree of risk. And then rebalancing those buckets on a regular basis is an ongoing kind of factor that you help your clients to establish and then maintain on an ongoing basis.
Yeah, no question about it. And, we're pretty big on dividend paying stocks, because those are typically larger companies that pay dividends out, certainly a little bit more stable. And yep, can they lag behind an Amazon? No question about it. But, you're typically not going to ruin somebody's retirement, with a focus on high quality companies with a long-term record of paying out some quality dividends. You can reinvest those dividends or take them out as income, as an example here, Peter.
Well, again, we are talking with Chris McIntire, president and founder of McIntire Retirement Services. You'd like to get your game plan for retirement put together, pick up the phone, give a call, 800-868-1194. That's 800-868-1194. Chris, rebalancing in general, one of your hot topics, and cycling back for a little bit of a play on words here, because the tech sector that you had mentioned earlier has had a very strong year, but last year it led the way on the decline. Can you talk to us and tell us how this 2-year cycle is a case study in why rebalancing may be so important?
Yeah, absolutely. So let's say 2022, for example, and, let's say your stock portfolio fell 25% and your bond portfolio fell about 10. So you're going to typically rebalance on a quarterly basis. That's kind of the rule of thumb. And so that means you're going to shift more out of bonds into stocks to keep your 50-50 ratio, just to make it easy here. And then so you put more money back into stocks when stocks were down. And then as the market has taken off here, you've been able to have, you bought when it was low, and you should have, gained some returns off of that for 2023, as the tech sector, Amazon in specific, has, gone up like a rocket ship here. It's just, it's a very true and, proven formula for long-term investment success. And, a lot of times what a lot of investors do is they're watching TV so much and shifting and making telephone calls and saying, Chris, let's do this, let's do that. And, and sometimes it's to their detriment even, to say, well, this didn't work, and I got, number of clients that just, at the end of last year, it was so god awful. They said, let's just shift into a CD, and here's stocks and whatnot have rebounded strongly. So, sometimes it takes a little bit of stomach. Investing is for the long term. And that's why you have your short-term dollars, to help you get through some of those downside years in the market.
Chris, by having a little bit of an iron stomach there, but Also, by having the discipline to do some of the fundamentals like rebalancing along the way, you could have actually taken advantage of that downturn in the tech sector and now the reversal and the upswing in the tech sector. Whereas if we just had a buy and hold approach, which is by and large what Americans have been told and taught to do, and generally what we do if we are not rebalancing, really we wouldn't have taken much advantage of it. We would have just rode the wave down and now are hoping to float back up. And so that is one of those areas where having the guidance and working with a professional can show its value and advantage in doing some of those routine items that make the difference in our financial future.
Yeah. And, let's take 2023 to expand on that again. So let's say you're 50% stock portfolio, 50% bond portfolio at the start of the year in January ends up being 65 stocks, 35 bonds, because, let's just assume we have a bull market. Okay. Well, at the end of the year, you want to take that back to your 50-50, proportion. And that means you've taken some of the gains off the table and you put them over here in your more conservative allocation. And then if the market dips into 2024, then you'll do a rebalance and take some money out of bonds and put it back into stock. So, that's a perfect analogy there, Peter. Thanks. I think that was a great segment there for folks.
And Chris, if we have not done that along the way, that is actually one of the reasons that a lot of people lost more than they should have or were comfortable losing in 2022, because many times we forget to do that routine rebalancing, especially with our 401ks, which are so automatic and out of sight, out of mind, that oftentimes some of those routine financial fundamentals get neglected.
Yeah, it certainly is. And, rebalancing, tax loss harvesting, dollar cost averaging, when the market goes down, that's when you want to make additional purchases. Again, for those of you that have the ability to do that, if you're still working. And, in 2022, I had clients say, boy, should I still be putting money into my 401k? It keeps going down every month. It's like, you absolutely should. You're buying more shares on the way down, buy low, sell high type of mentality.
Once again, talking with Chris McIntire, president and founder of McIntire Retirement Services. If you've got questions, if you'd like to get your game plan for retirement, the written plan in your hands, the document outlining your financial goals and the strategies that will help you achieve them efficiently and effectively, pick up the phone, give a call, 800-868-1194, 800-868-1194. You can also visit online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. Excellent resources, including a library of podcast programs on a variety of specific topics, ladies and gentlemen. Almost any topic that you would want to find out more about or listen to a qualified, experienced professional's take on, you can find there at the website, McIntyreRetirementServices.com. Or if you'd like to have a specific conversation about those issues and your specific situation, how they pertain to you, you can always give Chris a call, 800-868-1194, 800-868-1194. Chris, retirement really is about trying to narrow the potential path and outcome. Trying to figure out and project out where we are going to be without a large delta or range of potential outcomes, trying to figure out where we are now and sort of map out where we want to go and get to and finding the most certain route to get there. Kind of liken it to it's hurricane season now down in the South. They have to worry about every single storm that's out there because those spaghetti maps seem to take them from Florida to Maine every time, right? If they knew exactly where it was going to hit, I think that we could do a lot more as far as protecting those that were in its path. But because the range is so wide at the onset, it's kind of like everybody either has to panic for every storm or eventually we get tired of doing that and tend to ignore it. And then unfortunately it hits. If they could tell us 2 weeks out that this is going to hit within this 10-mile range, we probably would do a lot better job in preparing. And sort of the same thing, but the opposite way with retirement is if we could figure out how to narrow that range, we could plan with much more efficiency, effectiveness, and confidence.
We certainly could, and I mean, we deal with a variable when we're talking about stock prices, bond prices, geopolitical forces at play here. So, that's why it's important to, stay within your overall risk tolerance. And starting 2023 here, the tech sector has done incredibly well. That's the growth sector, right? Those are typically companies that aren't big dividend payers. We had a couple of bank failures, so that hit the finance sector of the stock market. Dividend pieces were down in value. Dividend paying stocks were down to start the year. That could certainly, have a role reversal as we get toward the end of the year, and earnings come out better or whatnot. Hopefully we had this banking crisis behind us. And, I was driving home from Nashville, Tennessee the day that, we thought Russia might have another civil war, and, here it ended up so far, none of that happened. And, who knows what's going to happen over there, it's anybody's guess. But, could you imagine if that army column would have stormed into Moscow and Russia breaks out into civil war? What would have happened to energy prices, wheat prices, and things like that? And, just so some of those geopolitical things are just so hard to predict, and, who knows what's going to happen. And that's why you have a safe money strategy in your investment strategy. And if you have an income plan, all those different pieces in case things like this happen, because they do.
Yeah. And these are why we talk with Chris McIntire each and every week to stay up to date and on pulse with the hot topics, the current events, but also the fundamentals of long-term planning and financial success, ladies and gentlemen. And if you would like to have those conversations pertaining to your specific situation and your financial future, Chris McIntire is your resource. Pick up the phone, give him a call, 800-868-1194, 800-868-1194. Chris, several items left in your list of hot topics here, but only a minute or two left in the program. So I'll give you an either or choice: sequence of returns risk or taxes. Which do you think is more pressing to address here in the finale closing of the program on our hot financial topics?
We'll take sequence of returns risk. So again, to go back to 2022, a sharp downturn, that sequence of return, was maybe a negative 15 or something for an overall portfolio. 60-40 portfolios, that moderate risk, type of portfolio, took a substantial hit last year. Most of that was just the interest rate shock, okay? And that is starting to rebound here and, recovering some of those losses for 2023. And sometimes it takes a year or two for that. So you have to have the flexibility in, look, if all of my eggs are in a 60-40 basket, I may have to slow down my withdrawals when the market takes a hit so I can leverage that sequence of return risk or help to mitigate it. And then when the market goes up strongly, maybe I take a little bit extra out and I refill my cash bucket on an up year.
So it's important, ladies and gentlemen, that you understand how the sequence of returns may impact your financial future and how routine monitoring, updating, rebalancing can help to preserve and protect when we face challenging times, capture gains when we face opportunistic times, but maintain the path and have a more predictable, confident outcome into and throughout your financial future. That's what the game plan for retirement, written financial and retirement plan, is all about. That's what the conversation with Chris McIntire at McIntire Retirement Services can help you get started. Pick up the phone, give a call, 800-868-1194, 800-868-1194. You can also visit online, McIntyreRetirementServices.com. Resources on just about every financial topic or question, but always welcome to ask those questions individually, personally with Chris McIntire, your resource. 800-868-1194, 800-868-1194. Chris, we always appreciate your time. Great conversation on the program today. So much that we hit on, but really I think that it all boils down to having that plan in place for our financial future to instill and give us that lasting feeling of confidence as we face new variables and hot topics and headwinds into our financial future, which we certainly will.
Hey, my pleasure. I hope everybody has a great weekend out there. Stay safe.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.